Now we will take a moment to introduce you to our speaker. Our speaker today will be Stephen Bland. For the past 12 years, Stephen has served as the Education Director for AGA West Michigan, leading its quarterly webinar series, as well as a number of live events. He is also a principal at Raymond, where he serves as the firm's Public Sector QC Director and as a member of AICPA's Government Audit Quality Center Executive Committee. Stephen is a CPA and a certified government financial manager with over 27 years of experience in the governmental and nonprofit arena. Stephen, you may begin the presentation.
Thank you very much, Ashley, and thank you everyone for joining us for our 12th annual single audit update. I was going back through my old training files, and we've been doing this since 2010. It's been quite a ride. So what are we going to talk about today? Well, we're going to do our normal refresh on the basic structure of what goes into a single audit, just to kind of reset and level set our expectations about what happens there. There haven't been any major changes into the fundamental structure of a single audit, at least for most programs, but there have been a few important nuances and one very significant new option that's been introduced for smaller entities that might be new to the single audit space. We're going to walk through the major provisions of the uniform guidance that are applicable to entities subject to a single audit. And believe it or not, here we are in July, and we're actually going to be able to talk about this year's compliance supplement, not in a theoretical sense like we usually do with these updates, but actually talk about the guidance that was really issued in the past tense. The 2022 compliance supplement is already on the street, and we've had an opportunity to look through it, so we'll be talking through what's new there. There are some changes afoot with the data collection form, big changes actually coming later this year, and we'll be talking about those. And then what I alluded to is this new alternative compliance examination. Think of it as sort of a single audit light for entities that would be triggered into the single audit for the first time this year, specifically because of the coronavirus state and local fiscal recovery funds. More on that in the advisory section near the end of the presentation. I do also want to alert you to some small technical updates that were made to the Yellow Book last year. Nothing terribly substantive, but it's always good to stay current on what's going on with the professional standards that single audits are subject to. So without further ado, let's go ahead and dive into the meat of the presentation. As I'm sure you'll all remember, what we call a single audit is actually comprised of three distinct but overlapping parts, and that is a financial statement audit that's conducted in accordance with generally accepted auditing standards, or GAS, a financial statement audit that's then conducted in accordance with government auditing standards, or sometimes referred to as generally accepted government auditing standards, or GAGAS. More commonly, we just call it the Yellow Book. And finally, contains an element that is a compliance audit over federal awards expended. That's in accordance with the uniform guidance, or 2 CFR 200. So let's look at each of those three parts and talk about what we're trying to accomplish with them so we understand how the parts fit together into the whole. The financial statement audit really focuses around answering one very simple question, and that is, can those charged with governance, can the individuals who are relying on the financial statements, in the case of a government, can the general public, frankly, even in the case of nonprofits, which are public interest entities, can a reader of the financial statements rely on them to make good, sound financial decisions? Now, the audit speak we use is, are the financial statements free of material misstatement? Put another way, are they fairly stated in all material respects? Basically, are they accurate enough that if you use them to make good financial decisions, they'll be the right decisions? It's important to remember that a financial statement audit is not trying to answer the question, is this entity in good or poor financial health? You can determine that for yourself by reading the statements. The auditor's opinion is driven based on whether the financial condition that is displayed in those financial statements is accurate. And of course, auditors are never going to get to the point where they're going to say with 100% certainty, the numbers are 100% accurate, but they'll say they are accurate enough to use for good decisions, meaning they are fairly presented in all material respects. Any errors that might exist, we would expect to be immaterial, meaning too small to impact people's financial decisions. So the financial statement audit is all about that one opinion. Are the financial statements fairly presented? But in order to qualify as a single audit, that financial statement audit has to be conducted in accordance with government auditing standards. Now, it's a little confusing by its name. Government auditing standards are issued by the Government Accountability Office, the GAO, but they don't apply to all governments, and they don't apply only to governments. A Yellow Book audit or a government auditing standards audit can be applied to any financial statement audit, and that can be of a government or a nonprofit or a college or a university. And the idea is that this is applying an additional level of scrutiny, an additional standard that the auditors are held to because of the accountability associated with public funds. For this reason, governments are frequently subject to government auditing standards. Nonprofits, hospitals, colleges, and universities might be as well because of the public funds that are involved in those organizations. And it's an accountability issue ultimately. So the additional requirements that auditors are held to relate to independence, continuing professional education to make sure auditors are appropriately trained in the public sector entities they're serving. And ultimately, a Yellow Book audit builds on that foundation from generally accepted auditing standards, has all the same elements as a financial statement audit, but adds an additional report. Now, technically, that report is not an opinion. The auditor never says in our opinion on that document, but instead, the auditor points out anything that came to his or her attention during the audit that related to the internal control, the system behind the numbers. Essentially, an auditor is going to say, our focus was on determining whether the financial statements were fairly stated. But in order to do that, we had to look behind the numbers and consider the system that the entity uses to maintain those numbers. And in doing that, did anything come to our attention? Any deficiencies, any weaknesses in the design of the government or the nonprofit or the college or university's financial controls that we think would make it reasonably likely or more likely than not that something could be misstated in those financial statements. And depending on the degree of that, you're going to get some degree of findings that can come along for the ride. So a Yellow Book report really adds on some additional reporting. Not an opinion, but a report saying, did anything come to our attention that we think makes it at least reasonably possible that the financial statements could be impacted due to these control matters? And finally, the auditor is then going to build on that foundation even further, incorporating both GAS and GAGAS, the Yellow Book, to then add on compliance testing for individual major federal programs. Now, when a small nonprofit is administering a grant, that might be the only grant that they have. But a large nonprofit or a college or a government, they typically have multiple grants. And so a single audit is not going to focus on each and every grant they receive. It's going to pick one or more major federal programs. We'll talk about how auditors select those a little bit later. But once you've identified which programs are going to get tapped for more detailed testing, those are identified as major. And for each of those major programs, there will always be at least one, there may be several. The auditor is going to actually issue an affirmative opinion on compliance. Basically, yes or no, did the entity comply in all material respects with the rules associated with that grant? We all know from experience that the federal government never gives money away without strings attached. And whether that comes straight from the feds or gets passed through the state or some other entity on the way, those strings, those requirements, those compliance requirements have to be adhered to. And what the opinion is focusing on is, did the entity, did the non-federal entity who received federal funds carry out those programs in a way that complied with the rules? Now, in addition to the opinion on whether they comply, the auditor is also going to issue a report, again, not an opinion, on matters that came to the auditor's attention about internal control. But in this case, unlike the financial statement audit, where we said our focus was the numbers, but we looked at the system behind the numbers, here the auditor says our focus was on compliance with compliance requirements for major programs. But we also looked at the system behind the compliance. It's not enough for an entity to simply follow the rules. They need to have a good system in place to give them a good chance to continue following those rules. We want to make sure that we're keeping up with changes, that we have safeguards in place to make sure that all of those compliance requirements are indeed followed. So the auditor will issue a report on matters that came to the auditor's attention related to internal control over compliance. So in the end, we have two different direct opinions, one on the financial statements and one on major program compliance, and two different reports on internal control, one on internal control over financial reporting and one on internal control over compliance. And then finally, the auditor also gives an opinion, it's called an in relation to opinion, on the list of federal grant programs, the schedule of expenditures of federal awards. So whether that schedule has one grant program on it or 50 grant programs, it's a list of all the federal grant activity that an entity had during its last fiscal year. And the auditor is going to express an opinion on whether that list is fairly stated in all material respects in relation to the financial statements taken as a whole, that financial statement audit that was mentioned in the first part. So those are all the parts and pieces that come together to make a single audit. You can tell there's a lot going on there. People can stop at any step along that progression and end up with something short of a single audit. Lots of entities have financial statement audits. A number of entities have financial statement audits conducted in accordance with the Yellow Book. But only a single audit then takes the extra step of adding on finally the compliance opinion on major programs. So where do all the rules come from that auditors have to follow in conducting these single audits, that auditees have to follow in maintaining their grant records throughout the year? It pretty much all comes from the uniform guidance that's found in 2 CFR 200. Now, just like the Uniform Commercial Code actually has little nuances in each state, the Uniform Administrative Requirements, Cost Principles, and Audit Requirements for Federal Awards is published in one place by the Office of Management and Budget, the OMB, that's 2 CFR 200, but then it has been separately codified by each individual federal agency somewhere else. I think we have a chart later on in the slides that references where you can find that information, but regardless, it's in the compliance supplement, and each federal agency has their opportunity to make small nuanced changes to the rules when they adopt them. Most haven't, most have adopted them without change, but it is worth noting that a few federal agencies add their own requirements. And we're not going to get into agency specific requirements today. We're going to stay at that uniform level. Just realize that it can be slightly more complicated than that in practice. By now, almost everyone should know that what we now call the uniform guidance is actually an amalgamation of guidance that had been separately issued in the past, and it's all been rolled together. The reason we keep including this data, that we keep showing what an A133 audit is, even though the uniform guidance was passed in 2013 and it's now been almost a decade since that guidance hit the street, it is still happening in practice that we see grant agreements and an old boilerplate language floating out there that still references some of these old OMB circulars. So if you see something referencing an A133 audit, if you see something that says you need to follow OMB circular A87 or A122, understand that those are out of date references, but you can still comply with the spirit of them by following the uniform guidance today, which encompassed all of that. So if we ever get to a point where I stop seeing A133 out in the wild and we can pull that out of this presentation, I'll be happy to. But I was actually just at the GFOA annual conference a few weeks ago and was talking about this, and somebody came up to me afterwards and said, "I'm so glad you mentioned that, because we have a saved report that we run every year for our auditors, and it's called the A133 report." And I had no idea where that name came from. So it's the little things sometimes that help us understand what we're looking at. So inside the uniform guidance, we have 6 subparts. The 3 that we care about the most for today's purposes are highlighted in blue. We've got the standards for financial management. That's what grant recipients need to do. We've got cost principles. That's the standards that grant recipients have to follow when it comes to identifying eligible costs. And we have the audit requirements, which is really the body of the single audit. There are also a handful of appendices to the uniform guidance, and the last 2 of those sections, neither of them are found directly in the UG, but there's references to them. We're going to come back and talk about both the data collection form and the compliance supplement a little bit later in the presentation. So we're not going to go into great depth about the uniform guidance today. We have had very in-depth training on this in the past, and there are still recorded webinars available, but just enough to remind you of some of the key highlights, and especially for those of you who may be joining us for the first time and are considering going through your first single audit or looking at that prospect, it's worth knowing some of the things that you will be held subject to. It's unfortunate, but it's a very true statement that a number of entities got federal grant dollars during COVID for the first time, and many of them signed statements that they were going to follow various rules in order to receive the money without fully comprehending everything that went into those rules. So this isn't a complete list, but this will hopefully at least highlight some of the more salient points within the uniform guidance. The first bullet should be very self-explanatory. If you're going to accept a federal award, you're signing up to follow all the rules that are unique to that award. Pretty straightforward. You're also signing up to have a system to track your performance, whether you're carrying out the objectives of the grant. Now, that's going to vary dramatically depending on the program. If you have a program for feeding the homeless, performance measurement might keep track of the number of meals served or the number of unique individuals who are served through that process. If instead you have a program that helps preschool children with developing the skills to succeed in future reading endeavors, your performance measurements are going to be completely different than a feeding program for the homeless. So these performance measurement systems have to be tailored to whatever the grant's trying to do. Now that got a little complicated in COVID because there weren't the traditional kinds of, here's a grant to do such and such, you can apply for it and then tell us how you carried it out. Those funds tended to be pushed out into people's hands in a very reactive, let's try to deal with the problems, the economic impact of the pandemic. But regardless, the need to track what you've accomplished with funds remains. We also need to have good financial management systems. And most of you are thinking, well, sure, I've got my general ledger, I'm in good shape. And that's probably true, but let's just make sure you've covered all of the different elements. You need to have a way in your general ledger to separately identify each separate grant that you have. So entities that were handling the coronavirus emergency rental assistance program, it's all one big emergency rental assistance program, right? It's all ERAP. Well, but there was ERA 1 and there was ERA 2, and they have to be accounted for separately. And the ability to know when one program stopped spending and a new program started spending and having discrete accounts for that is something that not everybody was spun up for. So remember, if you're going to administer more than one grant, you need a discrete set of accounts or some way of tracking that on a grant by grant basis. Fortunately, the uniform guidance doesn't micromanage how you do that. I've seen governments that set up a new fund for every grant, and that works. I've seen school districts that have a 4 or 5 digit account string buried in the middle of their very large chart of accounts to keep track of each grant separately, while otherwise using a uniform chart of accounts around other segments. That works. I've seen nonprofits set up classes or project codes and use the same physical trial balance account to keep things and then use some kind of class or project accounting to break things out by grant. That works. The important thing is that you can go to your general ledger, run a report, and know that the system is keeping track of each grant separately, not just the revenue, but the expenditures as well. The second sub-bullet there, a system that tracks good results, an adequate financial management system that keeps good records, straightforward. Support for federal draws means you need to have a system for determining how you're going to draw down funds, whether that's an advance or whether that's a reimbursement, making sure that you're following the applicable rules for minimizing the amount of time you're sitting on funds in advance of your actual needs. Appropriate internal control and good accountability over federal grants is a must. And here's an area to really watch for if you're new to the federal grant space, and that is written policies and procedures. Now, written policies and procedures are a best practice. We recommend them for all the compliance areas, but there are 5 very specific areas called out in the uniform guidance that have to be in writing. And if you don't already have these in writing, or if you do and they're not quite as complete as they should be, now's the time to get that fixed. Don't wait any longer, get that taken care of. Now, the uniform guidance doesn't micromanage whether you call it a policy or a procedure. They're pretty loose on the structure there. Does it have to go through just management review or is it a board review? The main thing is that it's written down and that it's enforced. You don't want to just borrow your neighbor's policies and procedures and put them on the shelf, because whatever you adopt, you're signing up to be held to that standard. You're basically saying, auditors, this is what I say I'm going to do. Now test to see if I really did it. So make sure your policies are reflective of what you're really doing and are appropriately tailored for your organization. So what are the 5 areas? The first one is payments, which is really just code for drawing money down. Now, some of the COVID grants recently have been a little different because funds have simply been pushed to us without any cash management requirements. But normally, we have to request a grant draw. We have to say, I'm ready for some funds, either on an advance basis, meaning I'm preparing to spend it, or on a reimbursement basis, meaning I just spent it, please pay me back. So depending on which of those setups that is, your policy should address how you determine the amounts you're going to request. How do you make sure that you're only requesting what you need and not more than you need? What is your record keeping system? And normally a best practice here would just be to make all of your grant draw requests based on what's either in the general ledger or the general ledger plus a reasonable amount needed for future advances as you've determined. The second area is procurement. If you're going to spend money through your accounts payable system on a federal grant, for those costs to be allowable, you have to follow your own internal written policies and procedures. Essentially, Uncle Sam says, I want to make sure you're spending my money, Uncle Sam's money, the same way you spend your money. Follow your own policies and procedures. Now, there may be a few times when the federal rules are even more restrictive than your own rules, but they never want you to be cutting corners or doing something less robust than you would with your own money. So I would say most entities probably do have policies and procedures around accounts payable. Who has to approve what when, what's the process for somebody authorizing, signing off on a check request or a purchase order, when do you require bids, all that kind of stuff. The one area you might be missing, and it just depends on whether you've put this in specifically, is the uniform guidance requires an explicit conflict of interest policy. A conflict of interest policy doesn't mean that you can't do business with the brother-in-law of the chairman of the board. It just means that the chairman of the board can't be part of the decision to pick the company owned by his brother-in-law. Essentially, you need to have a policy that has people recuse themselves from decisions that would benefit them directly or indirectly through a family member. So you've probably got your procurement policies down, but make sure you've got that conflict of interest included. People should not participate in decisions that could benefit them personally. The third area is very broad, and I would say that most entities are missing this until we bring it up to their attention, and that is the need to have a written policy on only charging grants for allowable costs. How do I know when a cost is allowable? Well, we'll put up a slide later to give you some general rules for that, but basically all of Subpart E, the entire cost principle section, is dedicated to describing allowability of costs. So your policy statement, your procedure could be as simple as, we're going to follow the uniform guidance cost principles, and we're going to assign a person with a responsibility to know those rules to be the person who signs off on costs before they're charged to a federal program. Not the only way to do it, but it can be an efficient one. The fourth item here is compensation. That's personnel benefits, basically payroll costs. If you're going to charge people's time to a federal grant, it has to be in accordance with your own internal documented policies and procedures. There are some additional special nuances that get added along for the ride when grants are involved. I have a slide for those later. But for now, realize that you can't charge any payroll to a federal grant unless it's consistent with your own internal written policies and procedures. Again, this is an area most entities are pretty good at. They probably do have a written policy about when people get paid and how they turn in support. You know, is it timesheets? Is it an exception-based system? How do they track sick and vacation time? Whatever those policies are, make sure they're addressed. And we'll talk about some of the specific elements that need to be in there a little bit later on. And the fifth area only applies if you're trying to charge travel costs to a grant. It is an allowable cost to send people to appropriate events, training, conferences, and the like for running a grant, and to charge those travel costs to the grant. But if you're going to charge travel costs, they have to follow your own internal written policies and procedures or default back to the GSA rates that are provided. So let's take a minute and check in on our Cpe prompt. This is the first of our 6 prompts. Honestly, it doesn't matter if you get the question right or wrong, just that you answer. We want to know that you're still here and awake, or at least faking it well. So our question is, entities that expend federal awards are required to have written policies and procedures over which of the following? Is it drawing down grant resources? Is it procuring goods and services? Is it paying employees? Is it all of those, or is it just items B and C? Go ahead and lock in your answer. And as we go down our list here, Hopefully from the last slide, it's all very familiar to you. We do need to have written policies and procedures on drawing down grants, on procuring goods and services, and paying employees. So D is the correct answer, but as long as you gave an answer, you're in good shape. All right, the uniform guidance also requires us to establish and maintain effective internal control. Now, that internal control needs to be over federal awards, and the goal of that internal control is to create a framework that gives us reasonable assurance, call it a fighting chance, that the entity who is managing these federal awards will do so in compliance with all of the federal statutes, regulations, and terms and conditions of the award. Basically, I need a system to help make sure we follow the rules, the strings that come attached to federal awards. So having internal control usually means having written policies and procedures, and we already mentioned it's a great best practice to have it all written down. So in addition to the 5 specific areas, broadly speaking, we need to have a good structure, a good framework of internal control. Uniform guidance tells us that that should be consistent with COSO, that's the kind of the gold standard of internal control, and the federal Green Book, really, which is just COSO for governments and nonprofits. So probably most of you have seen the COSO cube before. It's just a visual representation that indicates that internal control relates to our 3 broad objectives that every entity has. Operating or operations would be focused on efficiency and effectiveness of operations. Reporting is on capturing what's happened and being able to report that information to others. And compliance is just following the rules. Those 3 elements would exist in all organizations. This internal control has then 5 components: a control environment that focuses on the tone at the top, risk assessment that asks what could go wrong, and then control activities that do something to mitigate those risks of what could go wrong, information and communication that gets important data into the hands of the right people at the right times to act on it, and then monitoring, where we follow up and make sure the rest of the system is working the way it's supposed to. That COSO model was first adopted back in the early 90s. It's been updated in the 2000s, and it is the gold standard followed by everybody across all various industries. You may be less familiar with the title, the Green Book, but you'll notice a very similar looking graphic. The Green Book is the GAO's effort to take COSO and apply it into a public sector context. So it's the same 3 objectives, it's the same 5 components, and it's sliced down into the same 17 principles as COSO, excuse me, as the COSO report. Now we're going to take a real brief look at those 17 principles, because the goal here in the uniform guidance is that each of these 17 principles be implemented not just in the context of financial reporting, but also be implemented in the context of grant compliance. So try to keep that grant compliance in mind as we run through the COSO elements. I mentioned that the control environment is kind of that tone at the top. Well, the principles that the GAO reminds us we're looking for here is that the entity is setting that tone at the top by demonstrating a commitment to integrity and ethical values. We see that through ethics statements, through well-enforced policies and procedures, through the creation of some kind of an audit committee or something that sets that tone that says we care about internal control. We need to see actual exercise of oversight responsibility, an appropriate structure and authority and responsibility all laid out so people understand how the organization is supposed to operate. And then we don't just create a system and put any old people into it. We actually have a commitment to competence, finding people with appropriate skills and knowledge and expertise, and then also equipping them through training events like today to make sure they maintain that competence to carry out their job. And then ultimately holding people accountable for it. All of those collectively go into creating that environment where we can run federal award programs in an efficient and effective manner. Under the heading of risk assessment, an organization that is looking at the risk of non-compliance with grants needs to ask itself, what is it we're trying to accomplish and how much risk are we willing to tolerate? What is our threshold? What's our tolerance for accepting risk? You'll never eliminate risk entirely, but we can determine how much risk we're willing to accept and then put controls in place to mitigate those risks down to that level. So we'll define what we're trying to do, carry out the objectives of a particular federal award. We will determine the amount of risk we're willing to accept, and then we will identify those risks, analyze them, and respond to them in the next section here by putting mitigating controls. We're reminded in principles 8 and 9 that 2 of the risks we need to be very thoughtful about are the risks caused by fraud, that would be intentional acts committed against us, and the risks posed by change, meaning the world has just changed around us. Sometimes a well-designed control becomes out of date just with the passage of time. We've certainly seen fairly significant cultural shifts, workflow shifts over the last 2 years. Imagine a well-designed internal control that was completely dependent on people all being in the office in the same room with each other. Well, if that control was really dependent on that, shifting to a virtual environment would have required a modification to that control. And failing to make that change would have introduced a new risk. So that's the kinds of things we think about in the risk assessment arena when it comes to compliance. Control activities then are just those specific policies, procedures, forms, the steps that we put in place to try to mitigate risk. Now, be very careful, because internal control has frankly developed sort of a bad rap over the years as being that bureaucratic red tape that slows an organization down. And that's really unfortunate, because internal control was always intended to be a positive, a system that helps management carry out its objectives. I think what is largely to blame for the kind of preconception that internal control is red tape is some organizations have tried so hard to copy what other organizations do that they have picked up new internal controls that are not right-sized for their organization. That's where that comes from. So when you're designing control activities, when you're considering the impact of information systems and information technology on internal controls, and when you're putting those controls into place through implementation activities, please bear in mind the size and complexity of your organization and scale those appropriately for the needs. Once you've done your own risk assessment of what could go wrong at your organization, you'll find yourself a lot better equipped to decide what are the right controls to respond to those specific risks. Information and communication then is all about getting quality data to the right people and the right timelines. So it's an ongoing process. It's never quite over. It's iterative, back and forth as we're trying to get the best data into the hands of the people who need it. But it is, we're looking for quality information that we can communicate both internally and externally as part of that process. And don't forget how important monitoring is. This can be a periodic exercise or an ongoing exercise, but the idea is we would check up on ourselves periodically to see how well what we're doing is working. And especially if you're running a new grant program. If COVID has put new programs out there and you just simply don't have a track record of administering these programs for any prolonged period of time in the past, it's going to be important to periodically check up on how are we doing? Are we getting the kind of compliance that we expected with the policies and procedures that are put in place? We've identified certain steps, certain safeguards that we want to follow in order to give us a fighting chance at complying with federal rules. And if you don't periodically dive into the records and check to see if that happened, if you're waiting until the auditors come out to do that at year end, it may be too late to take real corrective action. Whereas if you check up on it yourself throughout the year and you find there's a problem, you still have a lot of year left to make those changes. And when your auditors do come, you can say, yeah, we had some problems, but we put those behind us. We've already taken the necessary steps to resolve that issue. And that's a much better place to be in when you've identified and evaluated issues and have actually taken time to remediate any deficiencies that were identified internally. Now, at the end of the day, you're going to need to document your internal control. Remember, I said it's a best practice we recommend that you document all your policies and procedures. Well, one of the things we have seen the feds emphasize the last few years is the need for that documentation to exist both at an entity level and at a programmatic level. Now, depending on the size and complexity of your organization, the same documentation may be able to serve double duty. But especially with larger and more complex organizations, we find that there are certain policies and procedures that fit the organization as a whole, and others that really need to be very program specific. Now, this slide is not any official guidance from the UG. This is just Stephen kind of shooting from the hip. But I would say that there are certain types of control, or there are certain types of components of internal control that lend themselves more to entity-wide focus, and others that lend themselves more to very granular program by program basis. So on this chart, we've said the control environment, the tone at the top, if you will, that frankly can really only exist at an entity-wide level. It's hard to envision a unique tone at the top on a grant by grant basis. On the flip side, control activities, those specific policies and procedures we put in place to respond to specific known risks, it's really difficult for those to be entity-wide at all. Those have to be very tailored, very specific. So it's sort of a progression where your documentation will tend to be a little more entity-wide on one end of the spectrum and very grant-specific focused on the other. Let's do our second CPE check-in just to see how everybody is doing. Which of the following statements about internal control over federal programs is false? We're looking for the false statement here. Grantees should have written policies and procedures. Policies and procedures should conform to COSO. Existing policies should be reviewed and updated as necessary. All grantees should adopt the uniform policies provided by the Office of Management and Budget. Go ahead and lock in your answer. And hopefully those first three items all sound correct to you because they are all true statements. We should have written policies and procedures. They should follow COSO or the Green Book, which is really just COSO for public sector. And we need to update our policies and procedures periodically as the world changes around us. The one thing that's not true, the actual correct answer, because it's the false statement on this page, is that all grantees should adopt uniform policies. There is uniform guidance, and that does direct us to the kinds of policies that we should adopt, but there are no uniform policies. The policies do need to be tailored by organization and right-sized for your particular entity. All right, let's move on. Under the standards for financial management, we also have a variety of other provisions, and we could spend a lot of time on each one of these, but I'm going to just briefly remind you of some of the high-level requirements. For cash draws and advances, make sure that you follow some kind of policy or procedure there to minimize the time that you're sitting on federal funds, except for those few COVID grants that provided upfront advances, that they're not applicable there. If you have a grant with a cost sharing or matching requirement where they want you to match the federal dollars with some of your own, make sure you have good policies and procedures around keeping track of that, doing the record keeping. Occasionally, a federal program will have program income, meaning it will help generate a revenue stream. And you want to make sure there are policies and procedures in place to see that those funds are reinvested into the program appropriately. The uniform guidance establishes a series of trigger points for when it's necessary to get grantor agency approval for deviating from your budget. It is actually far less onerous than what I see in practice a lot of times. So just encourage you to take a hard look at any contractual requirements that say, well, don't go over budget by more than X% in any particular line item. It's really not consistent with how the uniform guidance is written. The uniform guidance focuses more on carrying out the objectives of a grant and less on whether you did that with employees or contractors, or whether you spend a little more on travel or a little less on supplies. That's not really the focus of the uniform guidance. If you are buying tangible equipment over $5,000 unit cost or real property with federal grants, there are some very special rules about how you keep track of and inventory those assets and what to do with the proceeds if you were ever to dispose of them. And there's a fairly substantial amount of information to be followed for entities that have sub-recipients, where you have received funds from an entity and are passing them on to someone else to carry out a program on your behalf. So in those situations, sub-recipient monitoring and management adds a fair amount of additional requirements. I believe we have some slides on that, but it's important to note if you're passing funds through to others that you are subject to some additional requirements that you might not otherwise have been aware of. I highlighted procurement standards because I do want to walk through those briefly in detail. When we walked through the coronavirus relief fund at the beginning of the pandemic, it was a grant that didn't actually require following the procurement standards of the uniform guidance. More recently, other programs, including the state and local fiscal recovery funds, have been subject to the procurement standards of the uniform guidance. And so it's important to know what those incremental requirements are. Now, if you happen to be a state government, you get off easy. You just follow your own policies and procedures, and the feds don't take it any further than that. But for everybody else, for counties, for cities, for villages, for special purpose governments, for school districts, for nonprofits, for hospitals, for colleges and universities, basically everyone who's getting a federal grant who isn't a state, you have to follow the general procurement standards. Now, the good news is the very first rule of the general procurement standards is follow your own internally documented policies and procedures, kind of a you do you policy, which is helpful. You do explicitly have to have that no conflict of interest policy that we mentioned earlier. And the general rule is consider whatever is the most economical purchase option when spending federal dollars. Now, what's interesting is consider the most economical purchase option does not necessarily mean the cheapest bid. It might mean the lowest bid, but it doesn't necessarily mean the lowest bid. And so what's important to note there is the most economical purchase option, actually what it takes to prove you've done that actually varies and scales a little bit by the size of the purchase. So here is what the OMB refers to as the procurement bear claw. Makes me hungry for a sugar glazed cinnamon roll or something. But the procurement bear claw identifies the general standards that we always have to follow. And then the 5 specific ways that purchases can be made depending on the size. Now, overall, our overall objective is all procurement transactions must be conducted in a way that is providing for full and open competition. Great, but what does full and open competition really mean from a practical perspective? Well, for very small purchases, and I do need to point out here that when we say very small, we mean very small to the feds. For micro purchases, and that's purchases under $10,000, those purchases only need to be reasonable. The feds don't require any kind of comparison shopping. They don't require any kind of competitive bids. If it's under 10 grand, just as long as the cost is reasonable, you're in good shape. Now, that doesn't prohibit you from doing price shopping. It doesn't prohibit you from doing proposals or things at that level, but it's definitely not required by the feds. But remember, I said you do have to follow your own internal written policies and procedures. And it's possible that you have a policy that says at $5,000, we have to go out and do some comparative shopping. If that's the case, you follow whatever's the more restrictive rule. But the feds say if it's under 10,000, it need only be reasonable. Now, you may have noticed the little blue asterisk by that number, and that's because as big as $10,000 is, the feds know it's not big enough for certain entities. So if you say we really need to have a micro purchase threshold that's bigger than $10,000, there's a few of you out there saying, gosh, that's huge. I don't need any more than that. But for those of you who say, gosh, I really do need a little more, the process is you can self-certify each year that you have done a risk assessment and have determined that the risk of making inappropriate purchases is appropriately mitigated by raising that threshold and still applying the micro purchasing rules up to, and you can pick a number between 10,000 and 50,000. There is a process much more formal to go even higher than 50,000, but let's just leave it there for the moment. If you believe that it's appropriate for you to be able to use a larger number, you just have to write a memo for the file once each fiscal year saying we've considered it, we've done the risk assessment, and it's our judgment that we can safely increase our micro purchase threshold up to pick a number between 10 and 50. Now, the feds say between 10,000 and 250,000, which they call the small purchase threshold, just getting 2 or more price quotes is enough. That can mean going online and checking prices at a couple vendors, picking up the phone and placing a couple of calls, driving around town and looking at a few prices in physical stores. As long as you can document that you did at least 2 or more price comparisons, that's all that's necessary. Obtain quotes and go with the most economical option. Economical does not necessarily mean cheapest if there's one product that's better for an appropriate reason. Now, once you get over 250,000, the feds are going to require some kind of more competitive formal documented process. Sealed bids where people have to clear technical hurdles and then low cost wins, or competitive proposals where price is a factor, but only one of many factors, and they get rated and the best one choose depending on which type of contract you're working with. Now, it's going to be important for any of these to consider your own thresholds. So if your policy says we need bids at 20 grand, you're going to follow your policy and not this 250, but otherwise that's the federal kick in. Now, there's also a rule or a provision that are non-competitive proposals. We call it sole source. And there's a process by which you can justify not competitively bidding something. The first reason to do it is because it's a micro purchase, meaning you never had to in the first place. But other options include there is no appropriate competition available. Now, make sure you've looked at this adequately. You've not unduly restricted who you're considering, but a lack of adequate competition, or we put this thing out to bid and we only got one bidder. We tried, or there's an emergency or a public exigency that allows us to make this emergency purchase and bypass our normal bidding. I would caution folks to be careful around playing the exigency card too much. At the beginning of the pandemic, no one was going to give you a hard time. It was an emergency and we had to do whatever we did right the heck now. But yeah, we're several years into this, and there are probably options to do a more formal competitive process for a number of different services and goods now. So just make sure you're really thinking through the whole exigency option before you claim non-competitive is appropriate. Ultimately, it's between you and your auditor and a federal cost monitor or oversight agency that might challenge your judgment there. When it comes to sub-recipient monitoring and management, things I wanted to point out here are largely the new emphasis on beneficiaries. So non-federal entities, that would be governments, nonprofits, and higher ed that receive federal grants. They can receive those as recipients, meaning it came straight from the feds. As sub-recipients, the feds gave it to somebody who gave it to you, or maybe somebody who gave it to you, or contractors, meaning you're providing goods and services in the ordinary course of business. Now, it is obviously less common for a government or a nonprofit to be a contractor, but it can happen. It is more common for a government or a nonprofit to be a subrecipient. But with the Coronavirus Relief Fund and the Fiscal Recovery Fund from ARPA, we had an increased emphasis on beneficiaries. And I'll define that in just a couple of slides. But the distinction of are you a recipient or subrecipient or contractor, it comes down to the substance of the agreement, not its legal form. A grant agreement can take the form of a contract. That doesn't make it a contractor. You can still be a subrecipient. Ultimately, you're going to have to use professional judgment. So what are the key distinctions? Well, a subaward is for the purpose of carrying out a federal program. I am running a program. I am a subrecipient. A contract is for procuring goods and services. And it creates a procurement relationship. It's subject to all those procurement rules. Now, in the definition of a subrecipient, we're specifically told that a subrecipient does not include an individual who is a beneficiary of an award. So in the uniform guidance, a beneficiary is a person. A person meaning somebody who's getting direct benefits from this program. They're not really a subrecipient or a contractor. They're a beneficiary. They're just benefiting personally from the way this program is designed. And that was very common in programs that were designed to help low-income housing or feeding the homeless, things like that. Those would all be beneficiaries. They got a benefit, but there's no expectation that they are themselves running a program. Both CRF and FRF broadened the definition of a beneficiary to be allowed to include entities for the first time. So some of those COVID grants were actually going to entities who had suffered economic loss and just needed funding. And there was no expectation of them running a program or providing any goods and services in return, simply that we're trying to help them recover from the economic injury that they sustained. So how do I know if I'm a subrecipient? Well, there's a list of factors that lean more subrecipient related. Do you determine eligibility? Is your performance tied to program performance? Have you been given programmatic decision making? Have you been specifically told in your award that you're supposed to follow federal compliance requirements? And basically, are you carrying out a program rather than providing goods and services? On the flip side, we actually have contractors who provide goods and services in the normal course of business operations, maybe to different purchasers and a competitive environment. And those goods and services are used in a program, but they're ancillary to the program itself. They may also be told explicitly in their contract that they're not subject to federal cost principles. Now, will you be lucky enough to hit all 5 checkboxes on one side or the other? Probably not. You'll probably have to use some professional judgment, and that's okay. It's just part of the process. In most cases, if you're dealing with contractors, the only thing an auditee has to do is make sure that the contractor delivers on the contract. There are no program compliance requirements that pass down to contractors. So it can be very attractive to want to say, oh, I'm paying this entity as a contractor. But remember, if they're a contractor, they're subject to all that competitive procurement stuff. If they're a subrecipient, they're not subject to competitive procurement, but now you are required to monitor them as a subrecipient, and they're subject to single audit rules. So there's a lot of give and take back and forth on pros and cons there. This is where the beneficiary distinction comes really helpful for CRF and FRF grants. Under the uniform guidance, the question of whether an entity is a subrecipient or a beneficiary goes on whether the use of funds carries out a program. So FRF recipients are allowed to use funds to establish grant programs to help out organizations like businesses and nonprofits, et cetera. In these cases, these organizations would be even beneficiaries of FRF rather than subrecipients because they're not using those payments to carry out a program. In that case, they're not subject to the Single Audit Act or to CFR 200 subpart F. So what FRF is saying here is entities that might otherwise seem like they would be subrecipients might actually be beneficiaries, and that's very helpful. Now, if you're in the boat of saying, gosh, I think I might be a beneficiary, you might be right, but it's not a call you ever get to make for yourself. Only the pass-through entity can decide the format of how they're passing funds along. So if your pass-through entity thinks that you're a subrecipient, you are. Now, you can try and talk them out of it, get them to issue an amendment to change how it's been documented. And we've seen real-world examples of that during the pandemic where folks have said, I started off calling people subrecipients because that's all I've ever known. I didn't have anything else that I might be able to try to call them. And so that's what I went with. But now that we're thinking about it, I'm not really asking them to run a program. I'm not asking for anything in return. This is really just helping them out because of an economic injury they sustained. I think they're more of a beneficiary. Okay, communicate that in writing after the fact and release them from any single audit requirements. That's great. So it's a new area, it's nuanced, and ultimately, if you need to have a conversation with your awarding agency, I would encourage you to consider doing that. When we get to subpart E, these are the cost principles, all the rules that go along with federal grants. The feds have a fairly ambitious statement that, hey, following these rules shouldn't require you to do anything you wouldn't have done anyway. All we're asking for is plain common sense. We can quibble over whether they're right on that or not, but the bottom line is they say the point of this section is to define what a program costs to run. Not going to guarantee that your grant will cover all those costs, but before we can decide what we are going to cover, we at least have to agree on what it costs to run the program. So that cost is going to be made up of 2 positives net of 1 negative. The 2 positives are the allowable direct costs and the allocable indirect costs, and it's going to be net of any applicable credits. So what's an allowable cost? Well, an allowable cost is anything that's necessary and reasonable for the performance of the federal award. Reasonable is an awfully subjective term. It has to follow the rules that are in the uniform guidance. It has to be consistently applied, policies and procedures that you follow, regardless of whether it's your money or Uncle Sam's money. You have to consistently treat it the same way as direct or indirect over time. And you ultimately need to follow GAAP, except for those cases where exceptions are given. And especially in the case of governments, there are lots of exceptions given to when you have to follow GAAP, just because of the nuances of governmental GAAP. You can't double dip and count the same cost twice. So if it's a direct cost or if it's a matching cost, those go in separately. And ultimately, this is the one you really have to watch. If you're going to charge costs to a federal grant, they have to be adequately documented. So if you go out and spend money on something absolutely appropriate, but don't keep a good paper trail, it can become an unallowable cost simply by virtue of lack of adequate documentation. Now, sadly, the federal government does not give a clear, bright line test on what is adequate in the documentation realm. So my advice is going to have to be, by necessity, when in doubt, document it. Over document it. Document what you were thinking at the time, why you thought this was eligible at the time, because by the time this gets pulled for audit, it could be 3 or 5 years later. You might be in a different role. You might be not around to be the one answering the question. Extra documentation will always help. Memos for the file, notes on purchase orders or check requests, they're all your friend, especially for those areas that might feel like they're kind of borderline. Like, what's our justification here again? Let's write it down while we remember. There are a lot of times where someone might raise an eyebrow at your professional judgment, but as long as you've documented it well, it will stand. They'll say, I might have done it differently, but I can't argue that what you did is wrong, and you documented it well, so we're going to call it good and move on. We had a question come in. Thank you for that. As a beneficiary, what kind of monitoring or documentation is required by the awardee? So if you are a beneficiary and you've received awards, the good news is those federal awards are not considered federal awards anymore. The money you receive does not show up in a single audit. It does not go on a CFA, and you don't have to worry about any of the requirements that relate to it. Now, is it still a good idea to keep some documentation internally? Sure, it's always a great idea to document things. But as a beneficiary, these are not expenditures of federal awards, and so all of the requirements of the uniform guidance end up not applying to those situations. In many cases, and I don't want to oversimplify this because every grant was a little different, but in many cases, if you're receiving money as a beneficiary, it's because you've already incurred the economic harm. The loss is behind you in the rearview mirror. And whatever funds are being provided to you, it's not with the expectation that there's something you're going to do in return for them. They're making you whole for what's already occurred. So there's really no need to document because all the costs happened in the rearview mirror. Obviously, check your own agreement. If there's something that was written into a beneficiary agreement that requires something above and beyond what I just said, you need to follow that. But as a general rule, uniform guidance doesn't apply to payments. And then we had a follow-up question: who determines if an entity is a beneficiary? Only the pass-through entity passing funds can ultimately make that call. So if you weren't identified as a beneficiary and think you should have been, have a conversation with your pass-through entity. It is not, in many cases, it's not too late to go back and have those determinations amended later when we determine, you know what, beneficiary really is the right answer. Especially if you start thinking through the practicality of how would an auditor even test how I used these funds, that might really help get you the right answer there. All right, let's go ahead and move on to one specific area of costs that I want you to be mindful of, and that is costs for personal services, meaning payroll. Very principles based. The uniform guidance moved away some 8 years ago now, moved away from rules based. These are all the things you have to do and how you have to do it, and we're gonna zing you if you don't do it exactly the right way, and move to a much more internal control based approach. So can you charge time, payroll dollars to a grant? Absolutely. As long as the costs are reasonable for the services that were rendered, they follow your own internal policies and procedures, and they are determined and documented following the standards for documentation laid out in the uniform guidance. Remember, in order for it to be allowable, it has to be adequately documented. In the one case of payroll, they do tell us what is adequate. So what's necessary for something to be adequately documented? Well, you need to have good records that reflect the work that was actually performed. So some system of internal control that captures the work that was performed. Could that be a timesheet? Sure, doesn't have to be. Could that be a personnel activity report? Sure, doesn't have to be. Could it be a time log? Yes, doesn't have to be. Some system of internal control that accurately reflects the work that was performed. Something that's officially incorporated into your accounting records and keeps track of 100% of the compensated time. You can't say, well, I worked 10 hours on this grant this week, that's my timekeeping. Like, well, how many hours did you work in total? Well, why does that matter? I told her I worked 10 hours on the grant. Well, it matters because you're paid by salary. And I don't know if that means, if those 10 hours mean 10 out of 40 hours, so 25% of your salary was grant related, or if that was 10 hours out of 50 and 20% of your salary was grant related this week. We need to somehow consider the whole. So it could be as simple as I worked 50 hours this week, 10 hours on grant and 40 hours on non-grant. Okay, as long as we've accounted for 100%, we're good. The level of detail is open to you. Needs to comply with your established accounting policies and procedures. And whatever system you set up, it needs to provide a reasonable basis for spreading those payroll costs to the various cost centers. Now, you can set a budget up front, that's fine, but you can't rely solely on that budget unless you've got a really good system that produces accurate estimates in advance, and you have a system for checking up after the fact to make sure that's what really happened. It's great that you budgeted well. Is that actually what happened? And as long as you can build that into your system of internal control, then they're fine with it. In fact, short-term fluctuations, someone was out sick, someone was on maternity leave, those are all fine, but as long as the internal controls pick up an after the fact review and any errors are corrected, that can comply. So very, very different than things used to be under the pre-uniform guidance. Let's do our third CPE check-in real quick here. When you are charging personnel costs to a federal grant, what should you do? Should you follow your own documented policies and procedures for personnel? Should you allocate costs between various programs on a reasonable basis? Should you follow the standards of documentation found in the uniform guidance, or should you do all of those? Go ahead and lock in your answer. And hopefully you all got this correct. We should absolutely follow our own policies and procedures. Any allocations should be based on a reasonable basis, and we do need to comply with the standards of documentation. So item D, all of the above, is our correct answer. D was the correct answer. All right, that catches us up to the single audit, which is, of course, the main event that we're here for. Let's zip through this pretty quick because this is the stuff that hasn't changed. Remember, a single audit starts with a foundation of a financial statement audit following generally accepted auditing standards and the Yellow Book, and it adds some additional requirements. So the next few slides are going to fly by, but it's not new information. 4 stages to a single audit. Stage 1, do I even need one? Start with the CPA. That is a schedule of expenditures of federal awards. It's a list of all the grants, not the cash that you got in during the year, the money you spent on those grants. Pass-through entities often say, well, I gave you $800,000, so you need a single audit. Well, you gave me $800,000, but I spent $400,000 of it in fiscal year 1, and I spent $400,000 in fiscal year 2. So both of my fiscal years were under $750,000, and I didn't need a single audit. That would be the correct answer. So our question is, do we spend at least $750,000 across all federal grants, excluding beneficiaries, because those don't count, in a single fiscal year? If so, then a single audit will happen. The auditor will do some testing of that CPA to make sure it's complete. Now, the auditor is going to group your grants by assistance listing number. It's just a code that the feds attached to it. We used to call it CFDA. Now it's called assistance listing number. It's the same thing. The auditors are going to then group your programs into 2 camps, Camp Big and Camp Little. We call them Type A programs and Type B programs. That cutoff starts at $750,000 for most of us, and then it can go up for really large CFAs. And the auditor is going to go through and do some risk assessment based on past audits. And they're going to ask, has this program been tested in the last couple of years? And if so, what were the results? Depending on that process, the auditor may also look at some of the smaller programs. We start with big programs, then if necessary, we look at smaller programs. The auditor goes through and picks a certain percentage of programs and tries to make sure they've got good coverage. And when it's all said and done, they say, if these are my major programs, what percentage of the CFA will I have tested? If you're an auditee who has had a consistent track record of single audits filed on time without material findings, the auditor only has to cover $1 for every 5 on your CFA, 20% coverage. Now, if not, 40% coverage. And the auditor will pick 1 or more major programs until they've got that mix. So you can be guaranteed there will be at least 1 major program, maybe more. You can be guaranteed that any program bigger than $750,000 will be tested at least once every 3 years. It might be every other year. It might be every year. There's a lot of math that goes into picking those programs, but any big program is going to get tested at least once every 3 years. So having picked the programs, the auditor then has to ask themselves the question, what compliance areas should I test? Now, the compliance supplement, which we're going to show you in a minute, has a list of 12 different compliance areas. And each year, the feds get to pick up to 6 of them that they want the auditor to focus on. There may be others that are applicable. You have to follow all the rules, but the auditor is only going to test up to 6. And the feds can't count. So when they say 6, they actually mean 7 a couple of times. It gets a little confusing. But in any event, the auditor is going to say, did the feds want me to test it? Does it even apply in this situation? And even if it does apply, is it big enough to matter? Could it have a direct and material effect? And here's the list of those 12 different areas that the auditor works through. We have these on a later slide, so I'm not going to read through them now. And at the end of the process, the auditor issues a bunch of reports. We've got the in relation to report on the CFA, we've got the yellow book report, the single audit report, a schedule of findings and question costs, a follow-up on prior year audit findings, and then finally, we're going to wrap it all up into an electronic package called a data collection form and submit it for public inspection. More on that in a minute. So that's the context of what's happening with a single audit. Let's dive into the 2022 compliance supplement to see what it has to say about what's new this year. So the compliance supplement is issued every year, and it's designed to, it's really written for auditors to tell auditors what to do, but it is the ultimate open book test for auditees. So this is available on the Fed's website. I have a link at the end of the presentation that you can follow to look it up, and you can actually see in advance what your auditors are likely going to come and test for you. The April 2022 edition was released earlier than it's ever been. It was released on May 12 this year, and it's a big one. It's almost 2,000 pages long, but it is still not all inclusive. There are still programs not included in there, and there's special rules for auditors for that. But there's a lot of data there. Now, some of you may have remembered the last 2 years, the compliance supplement came out and then had to have updates. In fact, in 2021, we had two addenda and a technical update on top of that. The year before, we had an addendum. And what we've been told is no addenda are expected for 2022. Not only did we get the compliance supplement on time, we got it early, and we were told it's a done deal, it's not going to change. That's impressive. The one downside to that, of course, is the Infrastructure Investment and Jobs Act, IIJA, is not included in the 2022 supplement, and it won't be until at least the 23 supplement, which will be effective for June 30, 2023 year ends. So if IIJA, if the infrastructure grants start rolling out to folks and you start spending them prior to the fiscal year's June 30, 2023 and later, there's not going to be a supplement for that. So that's the downside of getting the guidance early, but we're delighted to have it early because we've had to wait for it for so many years in a row. The same as in prior years, the compliance supplement is divided up into 7 parts and a series of appendices. We're going to focus just on the highlights of those now. So the new compliance supplement is effective, even though it came out in May, it's dated in April, it's effective for June 30, 2022 fiscal year end audits and later. It cannot be applied to earlier years. But if there's information you need that was not in the 2021 compliance supplement, that is in the 2022 compliance supplement, while you can't technically follow the 2022 compliance supplement as effective, you can reference it as helping you design the procedures that you would perform for 2021. And for a few programs, that will be helpful. The OMB is quick to remind us that the compliance supplement only gets updated once a year. Well, it's been a few times recently, but going forward once a year, but laws change throughout the year. And so there's often a delay between when a new requirement kicks in and when it shows up in the compliance supplement. So auditors need to do something to stay current. One of the best things you can do is just go to training, go to state society events, go to AICPA events, keep up on the changes, and that's probably your best bet there. There are suggested audit procedures. So I said this was an open book test. Clients, auditees, you can see what the OMB suggests your auditors perform, but realize that their own professional judgment will have to be plugged in. There is a matrix in part 2 that lists the 12 compliance areas and tells you on a program by program basis for most of the, well, not most, but most of the most common programs, I'll say, whether that particular compliance area is subject to audit this year. Now, this is still relatively new, and people are still getting used to it. In prior years, the yeses and nos on the compliance matrix told you whether or not that compliance requirement was even applicable. Now, it does not tell you whether it applies. It tells you whether it's subject to audit this year, and that can rotate from year to year. So if you're an auditor, don't just roll last year's work papers, check to see if they've changed what they want you to test this year. And if you're an auditee, don't just follow the rules that the auditors are looking at, because the rules are the rules whether they get audited or not, and there's nothing that could stop a oversight agency from still coming in and checking up on it. So you need to follow all the rules that apply, even if the auditors aren't checking up on you this year. So remember, just because it's marked N doesn't mean it's not applicable to you. So here's just a quick example of what that looks like. There's a big matrix with the 12 areas, and anything highlighted in yellow is a change from the prior year. So in the 2022 compliance supplement, cash management came off the list for the child nutrition cluster. That's the national school lunch program at K-12 schools. And said, it's not that you don't have to follow the cash management rules, it's just they don't care about having auditors test that this year. Instead, they want auditors to test reporting this year, which wasn't on the list the prior year. So shifting responsibilities for the current year for the auditors will look at. Let's do our fourth CPE check-in. What are auditors expected to do? Is it perform only tests that are specifically included in the compliance supplement? Is it to apply professional judgment in deciding what tests to perform? Is it to ask for instructions from grantor agencies if a program is not included? Or is it to only test programs that have been included in the compliance supplement? What is it an auditor needs to do? Go ahead and lock in your answers. Well, our correct answer here is auditors need to apply professional judgment. We're not limited to only testing what's in the compliance supplement. And while you can ask for instructions, that is not a requirement and typically not something we would do. And as nice as it would be to say, oh, there's no supplement on that, I'm not going to test it, not an option either. So the correct answer on this one was B. Auditors are going to have to use professional judgment, though the compliance supplement is an excellent starting point. Now, part 3 of the compliance supplement walks auditors through the 12 concepts, the 12 compliance requirements, and gives general guidance that applies to all programs. When we get to parts 4 and 5, we'll get grant specific guidance, but this is the general guidance that applies to all programs. And it's worth pointing out that the uniform guidance had an update in late 2020 that mostly became effective in late 2020. There were some nuances to that. And so because of that, there may be certain situations where an existing grant is on the books that was issued prior to the new uniform guidance, and it's still subject to the old uniform guidance. If that's the case, then there's a table on page 3-2 to tell you what to do in those situations. But we're just going to focus on the new rules going forward. So part A, which is activities allowed and unallowed, is basically what you're allowed to spend the money on. Well, that varies completely by grant. A grant that's designed to feed the homeless, you can spend on feeding homeless people. A grant that's designed to provide reading instruction for disadvantaged kids, you can focus on books and reading time and activities. So what's allowable is very unique. Because of that, you're going to have to go to parts 4 and 5 where this grant specific guidance is to learn more about what you can do. Now, item B, allowable costs and cost principles, tells us that we're going to follow the uniform guidance, and that's subpart E. There's a lot of information in there. And the basic guidelines are those costs need to be reasonable and necessary for the proper administration of a federal award. Basically, don't waste money, spend it in a way that's prudent. It needs to be allocable to the federal award. It needs to be adequately documented. There's more to it than that, but those are the 3 really biggies. You want something to be an allowable cost, follow the rules in subpart E, make sure it's reasonable, necessary, related to the federal activity, and well documented. And that's 95% of what needs to be done. Compliance requirement C is cash management. And under the uniform guidance, cash advances are actually the preferred method of payment. We recognize that it costs money to run federal programs, and not every agency, especially smaller governments and smaller nonprofits, have the cash flow on hand, the liquidity to spend their own money first and get paid back second. If I had enough money to do this program on my own, I wouldn't have applied for the grant in the first place. I only applied for this grant because I need the money. So because of that, the uniform guidance encourages grantor agencies to pay with an advance. Now, not just here's all the money you'll need for the next 5 years. No, they want it to be a reasonable advance that kind of coincides with the actual needs. Now, if an entity is unable to be trusted with an advance, doesn't have good written policies or procedures, or has some kind of special conditions placed on them based on their risk, then they can move to a reimbursement method. Now, that used to be the default method. Now it should be the exception method of doing spend your money first and we'll reimburse you. When that happens, there is also a provision to say it might be necessary to give them a working capital advance. So we're back to advances either way. In that case, what we typically see is like maybe a 1-month advance and then reimbursement from that point on, with that advance finally being repaid at the end of the grant period. But one way or another, these are the compliance areas we're looking for. Have a good policies and procedures and make sure you're not drawing down funds earlier than they are needed. Item D is no longer directly applicable. Item E is eligibility, and who's eligible to receive services or benefits of a program varies by the program. But those rules might relate to the people being served, the geographic areas or groups being served, or even the sub-recipients who were selected. What does it take to be an eligible sub-recipient? Look to each individual program section and parts 4 and 5 for those details. Compliance requirement F is equipment over $5,000 and real property management. If you have equipment that's over $5,000 that was purchased with federal awards, it has to be properly maintained, appropriately insured, put on in your capital asset records or your inventory records, and you need to take a physical inventory at least once every 2 years to make sure it's still there. If you ultimately do sell any of that equipment that was purchased with federal awards, you need to reinvest those proceeds into the program. Matching, level of effort, and earmarking vary by program as well. So check parts 4 and 5 for the details. But in general, matching is where we say, I'm going to give you $75, but I need you to kick in 25 of your own dollars. And collectively, that gets us the $100 we need to run the program. So there's some kind of a local contribution, a local match. Level of effort says, before this grant came along, you were already spending $25 a year of your own money on the program. I'm going to give you a $75 grant, but I don't want you using that to offset what you're already doing. That would be supplanting your money. I want to supplement your money. I want to take what you were already doing and add to it. And earmarking would be setting aside a percentage of funding for specific purposes. Every program has a start date and almost every program has an end date. And so that constitutes that range gives you the period of performance. Federal dollars can only be spent inside that period of performance, and in general, unpaid obligations have to be liquidated within 90 days. We got a much broader window for obligation in the case of the Fiscal Recovery Fund. State and local Fiscal Recovery Fund gave us a 2-year liquidation, but normally the rule is 3 months. Incur your costs and get the bills paid quickly in order to comply. We talked about procurement earlier on. Remember that the thresholds are now at $10,000 and $250,000 for the various things, but you have to follow your own policies if they are more restrictive and roll those back. When you are entering into procurement contracts over $25,000, please make sure that you are not doing business with suspended or debarred parties. You can go to sam.gov and search for that. 27 years of doing this, I have yet to find anybody accidentally pay a disbarred party. So you still need to check, but the odds of it are fairly slim. Program income, we've talked about. What do you do if you generate program income? Reinvest it in the program. And then under item L, the big change here, and this change has kind of picked up some steam in the last year, is the return of the Federal Funding Accountability and Transparency Act, or FFATA testing. So FFATA, which is just a terrible acronym, Federal Funding Accountability and Transparency Act. FFATA is a federal law that says federal aid or first tier recipients, people who got money direct from the federal government, who are then themselves making awards to first tier sub-recipients of $25,000 or more, need to log into a website, which is fsrs.gov. And FSRS is the FFATA sub-award reporting system. So we have a double acronym now. Basically log in and say, I got a grant and I gave some of it to somebody else, and log all that information. That information is there because it's supposed to be public facing through usaspending.gov. Now, for this requirement's been on the books for years. This has been a requirement since 2011, but auditors haven't been testing it because they pulled it out of the compliance zone. They said, well, we the feds can tell whether this is happening or not. Auditors don't mess with it. Well, now they want auditors to test on it again. And anytime the feds tell auditors to test a report, they have to tell us what is the important part of the report. What do they care about? And so these are the required data elements that need to be reported under FFATA. The subawardee's name, their DUNS number, which is now transitioning to a universal identifying number and universal entity number or identification, unique entity identifier, UEI. There we go. I got there eventually. And the amount of the subaward, the dates, the subaward number, the project description. There's a lot of information. So when do I have to do this again? FFATA has been on the books for how long? It only matters if you got a grant direct from the feds. So already 90% of you are like, oh, good, all my grants come through the state or come through the county, and I'm off the hook. You have to get money direct from the feds for this to matter. And you have to turn around and make awards to others of at least 25 grand or more. If you're not doing that, this doesn't apply. But if you are, you need to watch the FFATA rules. So what are the auditors going to do? We're going to understand and test how you're doing your FFATA reporting. It's going to mean having you show us how you logged in and did all this reporting. And if you didn't do it, it's going to mean audit findings. In fact, the feds so much expect audit findings, they've even told the auditors how they want the findings to be formatted. They've gotten really specific. So they're expecting that there's going to be some issues here. And so they're kind of braced for that. Under the heading of sub-recipient monitoring, we are reminded that an auditor will be digging in on whether an entity first communicated to their sub-recipients that they are in fact subs, evaluated the risk of non-compliance, and then took specific monitoring activity to follow up on those entities, make sure they followed the rules. Now, special tests and provisions are usually so unique, it's hard to have a generic rule for them, but we've got parts 4 and 5 to help with that. All right, let's do our 5th CPE prompt, and then we'll get into some of the new stuff for this year. Which of the following statements are true? Auditors need to test all requirements that are identified as being subject to audit for a particular program. Auditors test all the requirements that could have a direct and material effect on compliance. Grant recipients might still be subject to compliance requirements even if the auditor doesn't elect to test them during an audit. Or D, all of the above. This one is tricky. Read carefully. So let's walk down our list. Do auditors test all requirements that are identified as being subject to audit? Well, not necessarily, because just because it's subject to audit doesn't mean it applies to a particular auditee. And even if it did apply, it might not have a direct and material effect on it. It could be a rule you're supposed to follow, but it has such a small impact on you, it doesn't really matter. Do auditors test everything that could have a direct and material effect? Well, no, not if it's not on the list of requirements subject to audit in the current year. So we've ruled out A and B, and by that we can rule out D. So that should tell us the answer is actually C. Grant recipients may still have to be following compliance requirements, even if the auditors aren't necessarily looking at those requirements. So be mindful of that. Part 4 is an area that gets updated each year, and there are always a number of new programs that are added. There's about 200 programs this year, which is consistent with the past. Some get added, some get taken away. That's just sort of how that works. But of the 200 programs that are listed in the compliance supplement, that's less than 10% of the active federal awards that are scheduled out at sam.gov. So auditors will not be able to find every program there, but the goal is the programs that have the largest dollar amount, the most number of recipients, those are the ones that tend to be in the compliance supplement. Now, auditors need to remember you're going to start in part 3 because that's the generic guidance. And when you go to part 4 or 5, which is where clusters are held, you need to look to see if there's a cross-cutting section. That is, before you get to the specific grant that you have from HUD, look at the beginning of the HUD section to see if there are any areas that are applicable to all HUD grants. And in the case of HUD, there are. So you start with part 3, then you go to part 4 and look at a cross-cutting section. And finally, you go to the detail grant from part 4 for your guidance. So auditors are looking in 3 different places, and auditees, if you're looking for the open book test that I mentioned to know what the auditor is looking at, those are the 3 places you should look as well. Part 5 is really the exact same as part 4. It's just focused on those programs that are clustered together. So there's a section for R&D, there's a section for student financial assistance for colleges and universities, and there's about 33 other clusters that are included in there. And every year, a couple clusters get added, some drop off. It's just a kind of a rolling thing. Now, for all of you auditees out there, the grant recipients, part 6 takes the green book that we've already talked about, which is a great resource, and gives you sample policies and or less policies and more controls, more specific actions that you could take to reduce the risk of non-compliance by compliance area. So it takes the 5 components and the 17 principles, and it walks you through in a very single audit friendly way, example policies and procedures. So if you're looking for, gosh, I don't really do much in this particular area, what might I consider? That's a great resource to go to. The part 6 of the compliance supplement even though the compliance supplement is kind of for auditors, this part's really written for auditees. Part 7 tells an auditor what to do if they need to test a program and it's just not there. Basically, go to the grant agreement and consider all 12 areas. We don't get to limit ourselves to 6 in those cases. So what's new this year? What are some of the new things that we're focusing on? Well, every year, the OMB releases a list of higher risk programs. And the list of higher risk programs this year includes everything that comes from the American Rescue Plan Act, and then specific additional programs that are listed here as well. So we have the Education Stabilization Program, which impacts K-12 schools and colleges and universities. We've got the Provider Relief Fund, which impacts healthcare organizations and some other government agencies. The Medicaid cluster has always been high risk, so no big changes there. The transit cluster has become high risk this year. There's been a lot of infrastructure money going towards transit, and so that has been bumped up as a higher risk. And then the big treasury programs, including the coronavirus state and local fiscal recovery funds. So what does it mean for these to be higher risk? Well, it means in all likelihood, if you've got them in any real size, they're going to be tested. It's not a guarantee, but it's a pretty good indicator. Auditors are going to have to consider that as part of their major program selection. We're also told that if the COVID funding that's in that program is not material to that program, it's a very small percentage, then the auditor could argue, okay, this program is really not going to be high risk after all. So how do I know if it's COVID related? They give us a list. If it came from the Coronavirus Preparedness and Response Supplemental Appropriations Act, or from Families First, or from CARES, or from CRISA, or from ARPA, any of those would be COVID related funding. So general rule, COVID funding, automatically going to be high risk. And that's where the focus is going to be for the next few years as this funding all gets used up. So the feds want some things special because of that. They want to know what's out there from they want to know what's out there from the perspective of COVID grants. So on the CFA, they're actually going to request that the COVID portion of any particular program be broken out from the non-COVID portion. So what that looks like from a practical perspective is if you have a particular program, in this case we have TANF, that has some COVID money and some non-COVID money, then what you would do is put in the amount of the non-COVID money and the amount of the COVID money on separate lines and put COVID-19 at the beginning of that row on the CFA. So it's all TANF. You're still going to have a total for TANF, but we have TANF with and without COVID-19. Then when we get to our data collection form, which is really just an online form that repeats information that's in the single audit report to get it uploaded into a database in searchable form. And I know some people aren't big fans of having to enter the same information a second time, but the reason is, yes, we're going to upload the PDF, and yes, the PDF is available to folks, but the database is very robust for searching and querying results. And by putting all these things into separate fields, we actually get the ability to look for very specific answers, which can be helpful for federal agencies and others alike. In the data collection form, we're going to do the same thing. We're going to break out TANF onto 2 line items, the non-COVID portion and the COVID portion. Now, in this case, the way to identify funding as COVID related is to use box C on the data collection form. It's called additional award identification, and it's a place where you can put in extra characters or information to help identify a program. So if you, in this case, just put COVID-19 in that box. Now, a few of you might be from schools, colleges, universities, and you may know that your big program, the Education Stabilization Fund, doesn't just have a 5-digit number associated with it. It has a 5-digit number followed by an alpha code. And you were already told to use box C for your alpha code. So 2 pieces of information here. 1, do that after COVID-19. So do COVID-19, a comma, and then your alpha code. And 2, don't just do the alpha code. They want you to redo the whole CFDA number with the alpha code because it's a lot easier to search for. Let me go back to your number here. It's a lot easier to search for 84425A than it is to just search for A. So when you're filling out your data collection form, anybody who's got alpha codes, make sure you repeat the full CFDA number plus the letter in that additional award identification. But if it's COVID, always put COVID first and then list that afterwards. They have now then extended that even further and say, we want COVID-19 to be in the heading and the body of any findings that are COVID related. So if there's a grant and it's a COVID related grant and it's got a COVID related finding, we want it to say COVID-19. Basically, when people do text searches of the database, they want to be able to find all of the COVID related pieces. Now, this is the biggest and most exciting part of what is going on right now, and it has been developing over the last few months, and we are really, really close to having some final guidance on it. It is the alternative compliance examination engagement. This is, for lack of a better word, single audit light. And it was created specifically for those entities who would not ordinarily need a single audit, but because specifically of the coronavirus state and local government, state and local relief, fiscal recovery funds rather, CSL, FRF, because of that specific grant, they were going to trigger a single audit for the first time. So what is your eligibility requirement to qualify for this single audit light? First of all, you have to have expended more than $750,000 in federal awards in your current fiscal year. If you spent less than that, you never needed a single audit in the first place, so don't worry about it. The Fiscal Recovery Fund, the FRF dollars that have to be received directly from Treasury or as a non-entitlement unit. Those are the only two people who qualify. So those who got the money directly from Treasury or as a non-entitlement unit through their state, those are the ones who qualify. If you are a nonprofit that had FRF dollars given to you, I'm sorry, you don't qualify. So you have to have had an award received directly from Treasury or as an NEU, and that award has to be less than $10 million. Why does it have to be less than $10 million? Well, because they put $10 million in as the threshold for the kind of the standard allowance for lost revenue, where we said, we're not going to make you prove lost revenue, and just up to $10 million you can spend on whatever you want. Essentially, it's not quite whatever you want. There's a few requirements, but it gets you really close. So if, as long as what you received is under 10 million and you're a direct recipient or NEU, then the question is, would your other federal awards, not counting FRF, have been under 750? So essentially, I'm under 750 without the fiscal recovery funds. I'm over 750 with the fiscal recovery funds. The only reason I'm getting a single audit is because of this one grant. If that is your case, if you are a direct recipient of $10 million or less, and that is what is pushing you over the single audit threshold, then you are eligible for this alternative compliance exam, this less than a single audit that still checks the box of a single audit. So here's the good news for you. You don't need a financial statement audit. Now, if you are a local government or a nonprofit who gets a financial statement audit anyway, fine, you're already getting it. But for some local governments, especially around the country and states that maybe only require biennial audits or don't otherwise require audits, this can be a huge cost savings. You do not have to prepare a CFA because the only program that's going to be subject to testing in the alternative compliance examination engagement is FRF. And we don't need a schedule of all the awards when there's only one being focused on. The testing that an auditor does of internal control to look at the system behind compliance is not required. Wow, we're taking a lot off the list. And the compliance testing that the auditor is going to do then is extremely scaled down. The auditor is only looking for ineligible expenditures. Well, gosh, there wasn't much. If you're doing the lost revenue calculation, there's not much that you can't spend money on under FRF. You can't put money directly into a pension fund to like do a makeup on a past funding deficiency. Okay. You can't use the funds to directly try to countermand federal efforts to stop the spread of COVID-19. Oh, okay. I mean, it's a pretty loose list. And then ultimately, you just have to be able to demonstrate that you did not significantly deviate from your normal policies and procedures. The bottom line is this: if you're going to use these funds for supporting your regular operations, spend them like you would have spent your regular operations. If you do that, that's it. The auditor is going to draw a sample of expenditures, run down that list and say, I don't see any illegal transactions in here, and move on. You also can't use it to make debt service payments. So you'll have to make sure that whatever your FRF award was you can cover costs without having debt service payments in there. But for most everybody, that's going to be fine. And so the auditors will just kind of check the box. Nope, they didn't spend it on anything illegal. Looks like they followed the normal policies and procedures, and you're going to get off really, really easy. So what does the report look like? Gosh, I had hoped I was going to be able to show you the sample report today. I was in a meeting with the AICPA just 3 days ago, and at that time, the reporting guidance was complete, through review, and in the hands of the AICPA's web developers to get posted. Did not make it before today's webinar. So we will be getting that guidance out as soon as the AICPA makes it available. But basically, it's a report for auditors to know what their opinion should look like. It's different than a single audit because it's missing so many of the elements of a single audit. The other thing that the AICPA is working on, and we're a little further out on this, should have it wrapped up in the next few weeks. It got delayed with some other more urgent projects, is a practice aid for auditors explaining how to document all this, because this is not technically an audit, it's a compliance exam. Some of the quality control documents will need to be different for that. So auditors on the line, stay tuned, that guidance is coming from the AICPA. Auditees, if you otherwise didn't need a single audit, this will very likely be a much more attractive option for you. You are held to a much lower standard. It will probably take less time to get the work done. And it doesn't, because it doesn't have to be, because it's not connected to a set of financial statements, you could continue to have your existing auditor audit your financial statements. And if they say, well, I don't want to do this compliance exam, I don't want to learn all those rules, or I don't do single audits, you could have another firm do this and it not cause any problems because there's no financial element involved. So that will put some nice options out there for especially entities whose current auditors just aren't spooled up for this kind of work. They won't necessarily have to change, which is great for them. That's what the Department of Treasury and AICPA were hoping to work together towards. The other thing that we don't have the answer for yet is what's going to happen with submitting these audits. The compliance exam, or the compliance supplement said, stay tuned, more to follow. There was some leaning towards maybe we can find a way to push these through the data collection form, even though they don't quite fit. AICPA's concerns about that because it really isn't a great fit. And so they're talking about maybe an email system, maybe setting up a web depository. They're working that out. We don't have an answer yet. The good news is these are due the same time single audits are due. So we still have a ways to go before the due dates for most of them roll around, and we're promised some guidance will be forthcoming soon. Speaking of due dates, bad news on that front. The last OMB extensions expired with our June 30, 2021 fiscal year ends. No further extensions have been granted, and no further extensions are expected at this point. And filing on time is necessary to maintain low-risk auditee status with the data collection form and the Federal Audit Clearinghouse. So timely filing is still important. And remember that filing, we're going to be back to the regular cadence now. A variety of other miscellaneous things that we have been given this year as updates from the OMB. Auditors following up on prior audit findings. I told you that they can change from year to year which audit areas are subject to audit. That yes and no box can move around. If there was a prior year audit finding, auditors typically have to follow up and see if it's been addressed appropriately. Well, intuitively, you might say, if I don't test this program this year, there's nothing for me to do. Well, the way the rules are written now, auditors need to follow up on all prior audit findings, even if that's not a major program this year, and even if that's that particular compliance requirement is no longer subject to audit this year. So there's an expectation that the auditor would at least check to see if the corrective action that was described in the prior year was taken. You're not necessarily going to do a full-blown test, but you're at least going to look to see if the corrective action they say that they took actually took place. There have been a few new clusters created during COVID, a few more this year even. When you add an existing or a new assistance listing number to an existing cluster, though, it begs the question, is it a new cluster or is it still the old cluster? I tested this cluster last year, but that was before you added this new assistance listing number. So here is what the rule is. If you add a new assistance listing, that is, if the feds add a new assistance listing number to a cluster, that makes it a new cluster that has not been tested before. However, if the challenge here is if the new program number is not something that's held by a particular entity, it wouldn't make a change to them. And if the new funding is less than 25% of the type A threshold for the auditee, then it wouldn't be enough to make it a new program. So it's some extra guidance for auditors to consider there. The Financial Audit Clearinghouse is moving. The U.S. Department of Census Bureau has carried this for decades, and it is transferring to the government, the General Services Administration. The General Services Administration is supposed to take this over in October, and they had initially said they weren't going to make any changes to the data collection form. Now, more recent scuttlebutt has shown a few things that might actually change as part of the conversion, but it's already looking questionable whether they can be up and running in time to make that October 1st deadline realistic. So right now, single audits with fiscal year 2022 year ends are supposed to be submitted to the new system. The Census Bureau won't take anything after 21, but the new system isn't up yet and isn't expected to be up until at least October. And so we're probably going to see an extension on filing the data collection forms have to be ultimately issued this year. But right now they're saying they're not going to issue an extension for completing the single audit. So the requirement would still be to get the audit done in hard copy format, but not do the upload until the data collection form is available. So don't bank on this as extra time. You just may have extra time to upload. The work still needs to get done on time. And that on time is going to be the earlier of 9 months after your fiscal year end or 30 days after the auditor wraps up their procedures. So here's our final CPE question, just to see if you've been awake the last 20 seconds. When would a June 30, 2022 fiscal year ends single audit be due? Would it be due December of this year, 6 months after the year end, March of next year, 9 months after the year end, June of next year, 12 months after the year end, or none of those? When would it be due? And unfortunately, our correct answer is D, none of the above. It would be due the earlier of B, March 31st, or 30 days after the audit is complete. So if the audit gets complete in less than 9 months, then 30 days after that is when it would be due, but never later than 9 months. So it's a little complicated there. We did have a question come in. What about a K-12 school that wouldn't normally trigger a single audit? Would they be eligible for the alternative compliance examination? And unfortunately, the answer is no, because they didn't get the funds directly from the feds or as an NEU through the state. So those would be pass-through funds. And unfortunately, this alternate compliance exam is only available to the direct recipients and NEUs. That's just the way they structured those rules, I'm sorry to say. All right, what changed in the Yellow Book? 2018 is still the official revision number that we're on, but there was an update in April of 2021 that was effective on issuance that's called a technical update. So they're still calling it the 2018 revision, April 2021 technical update edition. It's a confusing name. They added equity as an objective of accountability. So here's a quote from the Yellow Book. Management and officials entrusted with public resources are responsible for carrying out public functions and providing service to the public effectively, efficiently, economically, ethically, and equitably within the context of the statutory boundaries of the specific government program. So the COSO report already talks about effective and efficient operations. Economical, we could argue, falls kind of under the heading of efficiency, but ethical provisions and equitable provisions, kind of as a subset of ethics, have been added. So the federal government really wants to see its programs run in a way that is fair and equitable to all concerned. There was also a small adjustment to the requirements on ski in the Yellow Book. A few folks noticed that it was an accidental change, but a change that was made in 2018 that changed skills, knowledge, or experience, as it appeared in the 2011 Yellow Book, to say skills, knowledge, and experience in the 2018 Yellow Book. And that was not intended. So and became or again. What this boils down to is if an auditee wants to rely on their auditor to help with non-audit services, that's allowed as long as somebody at the auditee reviews and takes responsibility for the auditor's work. And the person doing that needs to have the skill, the knowledge, or the experience in order to oversee that work in a meaningful way. And so this is really not a substantive change. It's getting back to what the rule had always intended to be, but had briefly changed just by accident. If you want to look up any of this for yourself, we've got a whole series of resources here that you can go to find more information on this. I've been keeping my eyes on the questions. I haven't seen anything else come through. On a personal note, I just want to say how much I have enjoyed the opportunity to lead these webinars over the last 12 years. This is actually my final webinar as the Education Director for AGA West Michigan. We'll be passing the torch on to somebody else in future webinars. So thank you so much for the opportunity to work with you over the years. It has been my pleasure, and I wish you all a great afternoon.
This concludes today's program. Thank you so much for joining us. If you would like to learn more, please visit Raymond's website at www.raymond.com/government-resources. You can also email us at publicsector@raymond.com. Thank you and have a great rest of the day.